Hello financial fans, welcome back to another stock analysis. Today we'll be covering Medtronic stock ticker MDT. Medtronic is a global medical technology company that produces a wide range of medical devices and therapies aimed at improving patient outcomes and quality of life. The company's products are used in the diagnosis, treatment, and management of a variety of medical conditions, including cardiac and vascular diseases, neurological diseases, diabetes, and more. Some of Medtronic's most well-known products include pacemakers, implantable defibrillators, insulin pumps, spinal cord stimulators, and deep brain stimulators. These devices are designed to monitor and regulate the function of the body's organs and systems, either by providing electrical stimulation or by delivering medications or other therapies directly to the affected area. In addition to its product offerings, Medtronic also provides a range of services and solutions to support patients and healthcare providers. These include education and training programs, remote monitoring and data management tools, and consulting services to help healthcare organizations optimize their operations and improve patients' outcomes. They are currently sitting at a $109.2 billion market cap. In 2022, they generated a revenue of $31.7 billion, and the dividend yield is sitting at 3.26%. 58% of their revenue comes from their cardiovascular systems, 9% from medical surgical, 19% from neuroscience, and 14% from diabetes operating. To determine the final valuation of the company, we'll be using a margin of safety. Margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 25%, which can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using this scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has grown over the years, going from $4.7 billion in 2013 to $7 billion in 2022. The average EBIT growth is 5.3%, which is no change in the margin of safety. The margin has gone down over the years, going from 28.81% in 2013 to 22.33% in 2022. The average margin decline was 2%, meaning a 5% increase in the margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have gone up over the years, going from $1.04 a share in 2012 to $2.72 a share in 2022. The average dividend growth was 10.7%, meaning a 10% deduction in a margin of safety. The payout ratio is sitting at a very high 87.9%, meaning a 5% increase in the margin of safety, because the likelihood of them increasing their dividends by a lot further is very small with such a high payout ratio. The final two metrics are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For Medtronic, this is almost 1.5 years. In this case, 138% debt to EBITDA ratio, which is a 5% decrease in a margin of safety. The return on invested capital for Medtronic is sitting at 5.7%. which is no change in the margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Medtronic. The first valuation model that we'll be using is the discounted cash flow model. I've imported free cash flow of Medtronic going from 2013 to 2022. The average growth in free cash flow during this period was 6.73%, and I'm projecting an expected growth rate of 5% annually in free cash flow over the next 10 years. With this percentage, we can determine the future free cash flow for Medtronic and determine the terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This gives us a sum of free cash flow of $122.6 billion, and to get an equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $109.1 billion. All that's left to do then to get a discounted cash flow price per share is to divide it by the amount of shares outstanding, giving us a price per share of $82.03, which is very close to fair value actually. The The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of Medtronic, going from 4 years ago to the current year. The average growth rate in dividends during this period was almost 8% on average, and I'm projecting an expected growth rate in their dividends of 6% going forward. I will be using a discount rate of 8.5% again in this valuation, leaving us with a dividend discount model price per share of $115.33, which is a 40.5% upside from the current price. The third model that we'll be using is the multiple valuation. In this model, we look at similar companies to Medtronic, look at their stock price and their earnings per share. This way we can determine the average PE multiple in the industry, which in this case is 33.18. To get our fair value, we then have to multiply by the earnings per share that Medtronic is generating, which in this case is $3.09, giving us a fair value of $102.52, which is almost 25% upside out of this model. And the last model that we'll be using is the mean reversion theory. In this model we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years, and on average it has been sitting at 2.21%, while the current dividend yield is sitting at 3.31%, indicating that it's currently undervalued on this metric. With the PE ratio, the average PE ratio of the past 5 years has been 32.91, and the current PE ratio is 26.55, indicating once again that it's undervalued on this metric as well, giving us a total fair value of $112.20, which is a 36.73% upside out of this model. If you want access to all of the models that I use in my videos, you can check in the description for my Patreon link. Anyways, getting my self-promotion out of the way, let's go look at the final overview of our valuation next. Looking at our final overview, we've imported the discounted cash flow, discounted dividend. We haven't used Graham's valuation, as it did not give an accurate valuation out of this model. We have used the multiple valuation and the mean reversion theory, and on average we got a valuation of $103.02 a share. Our margin of safety we've determined earlier, using a standard margin of safety of 25%, deducting it by 5% for the debt to EBITDA, adding 5% for the margin growth, deducting it by 10% for the dividend growth, and adding another 5% for the payout ratio, leaving us with a 20% margin of safety. Applying this margin of safety, we get a fair value of $82.42. And with the current price of $82.06, we get a very small upside of 0.43%, which is indicating a slight buy. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.